Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Cucchiara, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Cucchiara.
Welcome in. This is Joe Cucchiara with the Real Estate Radio Live, the podcast series. Thank you for tuning in today to our podcast. We are with you 5 days a week, podcasting Mondays. Mike 𝗔𝗕𝗎, just a reminder, is doing a podcast for our series. Tuesday, it's Mike and I doing a podcast together, and then Wednesday, Thursday, I am solo, and then on Fridays, we have myself, Buddy, and Bobby covering wrapping up the week for Friday. So be sure to tune in. Just some information if you need to more information to contact us. It's 𝗓𝗡radiolive.com. That's the website. Do us a big favor to give us a review when you can on our podcast. If you go to iTunes, you could do that. Give us a great review. We would appreciate it very much. Tell us what you think about the podcast series. Or you could just go to 𝗓𝗡radiolive.com, pass it on to your friends, family, and coworkers, and pass the information on. The focus of this show has been for 6 years now, and we're really excited about the growth, and that is to educate and inform you, the consumer, to help make you wise, help you to make wise decisions in and around your real estate. It's pretty simple. That's our objective. That's our focus. We'll continue to do shows, guests, provide you with guest information, content that helps you make good decisions around your real estate, and hopefully you get educate you at the same time. Just a reminder, if you need any help with financing on purchase finances, refinances, anything to do with financing, that is my primary business. I'm happy to help you. You can contact me at 408-838-9060. Today's topic is going to be the Fed's increase on interest rates. What has it done? What does it mean as we wrap up 2016? What is it going to mean as we roll into 2017? And much more. So that's really going to be the topic of the conversation. When you're listening to this, probably a lot of people might be saying, oh my gosh, I've had enough of this whole Fed thing. We've been hearing about the Fed's raise and will they raise and how much will they raise. But we're going to bring it down hopefully to some simple terms and educate you on what we think it's going to mean for wrapping up 2016 and again rolling into 2017. So the Fed just met and she raised it by a quarter, which everybody kind of expected that. But leading into that, if most of you have been following the market before, even before that, when the elections were over on November 8th, when Donald Trump was elected president-to-be, the stock market rallied and interest rates went up, and they went up by about 0.5% or so. It went up quite a bit, the most we've seen in almost a year or so. No one really knew what was going to happen when the election was over, but that's what happened. That's what we're living with right now, and so you try to educate yourself the best you can. It really depends on what this means to you, and what I mean about that is if you have properties, if you have home equity lines of credit, if you have credit cards, if you have auto loans, all these things are going to be affected by the Fed's raise. So Janet Yellen just raised by a quarter, and the consensus is, or she made the statements of the effect that in 2017, she'll probably raise the interest rates 3 more times, which would get us up quite a bit more than we've seen in over a decade or so. So it's interesting times. It doesn't surprise me if you've been listening to this show for a length of period of time. You know that for the last couple of years, I have been advocating for people to get in, secure those low interest rates, take advantage of them. We have really, over the last several years, we got spoiled. And we're in this period of time for many years where most of us thought, no, rates are going to last forever, these historic low rates. It just doesn't work that way. We're lucky that we did really enjoy those rates for a long time. And so I know the clients that I've worked with for years, they were able to take advantage of these interest rates either in home purchases or refinances, not only the primary residence, but second homes, rental properties, and lock in those long-term low interest rates that really allow you to understand your budget better and manage your cash flow and debt servicing going forward. So good for those that took advantage of those low interest rates. If you didn't, in this podcast today, I'm going to talk a little bit about why you still might be able to do that and why it makes sense. I talked a couple of days ago about how you'd be surprised, even with the rates coming up as much as they have in the last 3 or 4 weeks, there still is an opportunity for people to save some money and make some wise decisions in their real estate financing, depending. And I'm going to talk about a couple of those reasons. So again, the Fed raised by a quarter. What that means is the market has been very volatile here the last couple of days. The official raise was yesterday. On Wednesday, since then, the stock market is still kind of holding its own. I do believe that at one point, this stock market has to take a breather. It really does. It has been heading north now for such a long time, and increased quite a bit ever since the elections were over. I have to believe, again, I'm not an expert in the stock market, and that's not my area of expertise. I follow the market as it relates to interest rates mostly, but the stock market is really, really taking a ride, and I just think that in the next 30 days we're going to see some pullback. Typically when we see pullback, that typically means we have a little relaxation and rates come back a little bit. So keep an eye on that. As we sit here right around the 15th, midway through December 15th, I would gather that sometime between now and about the mid-January, maybe the end of January, we're going to get a stock market pullback, maybe 5, 6, 7%, maybe as much as that. And when that happens, keep an eye on interest rates. It could be a little window that opens up for you if you haven't taken advantage of the rates, or maybe you're out looking for a home and you're looking at a purchase, and that could help you as well. So keep an eye on that. That's just my guess and my best guess after following these markets and getting an idea what might happen. I would definitely keep an eye on that. So then as we roll into 2017, the Fed will raise the rate again, most likely in the first quarter. Now, what could happen is, remember, there was a lot of false starts last year, too. The thought was, as we wrapped up 2015, if a lot of you remember, the Fed had made announcements, or the market had really talked about how most likely 2016 was going to be the first time that rates were raised. And we had 2, and most thought there was going to be more, and most thought there was going to be earlier in 2016, but ended up really happening towards the latter part of 2016. So going into 2017, I would think that we have a better chance, unless something happens we're really unaware of, that they will hold steady and true to these rate increases in 2017. The reason why is because, again, the new president will be in office. There's a lot more we know about some of the market conditions. And I just think now they're finally taking the foot off, really, and testing the market, if you will, this year with the raises. If you remember the last time they tried to raise, it got an opposite effect. Kind of had a negative effect for a while, and then they let it alone. The rates dropped back down. I do think the historic low rate environment is over, done with, and we have to wish it well and goodbye, because the all-time low interest rates, in my opinion, are gone now for a while. Who knows? Maybe they'll come back in the next cycle, 7 to 10 years. No one really knows. But those rates that we enjoyed for several years, I believe, are gone. When I say that, that's the all-time low interest rates, or the ones that hovered around record lows. It's still not a bad situation to have interest rates in the low 4% range. And I do think that by mid next year, maybe by second or third quarter of next year, we could see rates right around 4.5%, maybe a little higher. I don't think there's any fear of the rates getting near 5%, but I do believe that it's very likely that we could see interest rates around 4.5%. So keep an eye on that. The reason I want to share that information with you is because this could make a big difference in some of your decisions in buying and selling property. The refinance market's pretty much over. There's just situational refinances, and I'll cover those in the second part of this podcast. But there's still a lot of purchase opportunities, and where I'm podcasting from is in the Bay Area, where there's a strong business environment. There's not a lot of activity with investment properties, people buying investment properties here, but there is a lot of activity with people that are selling their investment properties and moving those 1031 exchange funds into different properties around the area. That's been happening and will continue to happen for sure. So I would take a look at what you have today. If you're set up, if you're squared away, if you have a 30-year fixed, you were lucky enough to get them in the low, the mid-threes, good for you. Move along, and you don't have to worry about that. Check it off your list. If you are one of the people that had an adjustable interest rate, maybe you took advantage of the rates and you really took advantage of them, and you got into one of these 7-1 arms, 10-1 arms, or maybe even any of these other potential adjustables. Now would be the time to take a look at that and see the reason why, and I'm going to talk about more of this in the second part of the podcast. I'm going to drill down really deep on why you need to take your adjustable interest rates very serious right now, and you need to take any secondary loans or third loans that are on your property. If you have home equity lines of credit, if you have fixed seconds, or any liens on your property at all, when I come back, I'm going to talk a little bit about how important it is to stay focused on those. We have been very fortunate that those have been excellent lately, but those are going to change rapidly, and they're going to make a big difference in your payment. And when I come back on the second segment, we're going to talk a little bit about that and drill down for that information. All right, we're going to take a quick break. When we come back, we're going to continue talking about how the Fed's increase, how it affects interest rates for now and going into 2017. I'll be back with you in just a minute.
For more information on today's program, visit 𝗓𝗡Radiolive.com. That's 𝗓𝗡Radiolive.com.
Hi, this is Joe Cucchiara, host of Real Estate Radio Live and Bay Area Mortgage Planner. In addition to being your home financing expert, please remember you could always contact me for other trusted advisors such as realtors, financial planners, and CPAs. Please feel free to contact me at 408-838-9060. That's 408-838-9060, or email joe at 𝗓𝗡Radiolive.com, or visit my website at 𝗓𝗡Radiolive.com for more details.
Welcome back to Real Estate Radio Live. For more information on today's topic or guests, just visit 𝗓𝗡Radiolive.com. That's 𝗓𝗡Radiolive.com. Again, your host for today's edition of Real Estate Radio Live, Joe Cucchiara.
Welcome back in. Thank you again for joining and listening, tuning in to the podcast today. This is Joe Cucchiara with Real Estate Radio Live, the podcast series. We're with you for the past 6 years, providing you education information on anything and everything real estate. Today's topic is the Fed's interest rate hike, what it means for 2016, and as we roll into 2017. I covered most of that in the first part of this. So as the second part of this podcast here, I really want to drill down deep on making sure people understand the liabilities that you have when it comes to adjustable interest rates of any sorts on your first loan, and then maybe home equity line of credits or fixed seconds, or any kind of liens on your properties that are not long-term fixed. So let's talk a little bit about adjustable interest rates first, or adjustable interest programs. Let's say you are one of these people that maybe a couple of years ago or recently you got into a 5-1 arm, 7-1 arm, 10-1 arm. There's out there. The idea of these programs is that you get a little better interest rate because you're kind of taking the risk, if you will, that you're either going to be out of the property or you're going to save a certain amount of money over that 7 to 10 year period, for example, to outweigh the potential risks as that loan adjusts 7 to 10 years from now, if we use that for an example. Be real careful about that and take a look at your program. Typically on these ARM programs, look at your terms. If you have any questions, you could always contact me. But look at your terms. Typically they go like this. Let's say you have one of these 7-1 ARMs. The 7 means it's fixed for 7 years. The 1 means when it adjusts, if you do still have the loan after 7 years, it adjusts to a 1-year, it recasts to a 1-year adjustable. So what you're going to do is look at your terms. Typically the way these work, if you do have your loan still when it goes into its adjustment period, there's a couple things that happen a lot of people don't understand, and I think it shocks them. One is it will turn into adjustable interest rate. Is no longer has a fixed period. So you have more volatility there depending on what the market's doing. We're going into a higher rate environment. We just talked about the Fed increasing the prime. That is going to affect these interest rates as they adjust. So keep that in mind. There's a chance, funny, a lot of people have held on to adjustable interest rates, including myself, until recently, because I knew we were moving into a higher rate environment. However, the last 4 or 5 years, these adjustable interest rates have been incredible. They've been in the low 3s, and once they recast, you could pay a lot of principal. So they're really good loans if you understand them. So here's what happens when and if that loan adjusts. So let's say you're in year 8. Leading up to that, you'll get a statement from your bank. They'll be notifying you. They'll say something like, they're going to remind you that this interest rate is now going to go to an adjustable at this date. When it does, this is your new anticipated payment. It's an estimate at that point because no one really knows what kind of interest rate or what the prime rate's going to be when they're giving you some kind of notification 6 months in advance. Okay, so now you come to the adjustment period. And let's say on January 1, your loan is due to adjust. You get the adjustment, it makes an adjustment, it will automatically kind of go to the market. So let's say you had a interest rate that was 3% on that 7-1 ARM, and now it adjusts and adjusts up a half. So now the first adjustment is a 0.5%. So now your interest rate is going to be 3.5% for the next 12 months. Now, the thing to really understand about this, and this is where you have to tune in, is that it doesn't sound like it's that big of a deal, right? 0.5%. It isn't, depending on your loan amount. Here's the parts that you have to be concerned about. Because that loan has already been fixed for 7 and you started that loan 7 years ago, when it recasts and adjusts after 7 years, the rate will not only go up, but it will recast as a 23-year amortized loan because you've already used 7 years off the quote-unquote loan that's amortized for 30, fixed for 7 program. This is the part that shocks most people. It'll be a principal and interest payment. It'll go up a 0.5%. This is just an example we're using. But the bigger part of it, instead of amortized for 30, it's now amortized for 23. What does that mean? That means that the payment is going to go up, could go up 10, 15, 20, 30% in some cases, depending. So those are the things to be really careful about. If you have an adjustable interest rate on your first right now, I would take a look at it, see where you are, kind of get an idea, plot out in your mind. You don't know exactly what's going to happen a few years down the road. And you might actually be in better shape to convert that to a fixed loan right now, believe it or not. Even though the rates are higher, you still might be in better shape. And I'll give you an example. Let's say you have a 3% interest rate right now on an adjustable, and it's going to adjust in a year. And right now you could get in and get a 30-year fixed for, let's say, 4%, just sake of conversation. Or another adjustable for 7 to 10 years at 3.5% or 3 5/8. You're buying yourself more time, and you're going to be saving some money on a fixed period of time for that during that duration. Believe it or not, it might be a good time to refinance right now, even though the rates have gone up, if you have an adjustable interest rate on your first and it's due to adjust in the next year or so. I would say take a look at that. If you need some help running the numbers, comparisons, I could do that for you. So this is a rule of thumb. If that is going to adjust in the next year or two, I would take a serious look at it, see what your rate is today, what it potentially could be when it adjusts. And I'll give you an example. If you're at 3% and your loan is going to adjust a year from now, and in a year from now we think the prime is going to be raised another 2 or 3 times, and let's say it's up, 3/4 or 1% from where it is today, that's going to make a big difference in the adjustment. You might be better off converting that loan right now into a fixed loan or extending it to another 7 or 10 year. Seriously, take a look at this. Don't take it for granted. We've been in a low rate environment for so long. My concern is this for a lot of people. My concern is that you're lulled into this thinking that it's going to last forever. Oh, I'm not going to worry about it. When it comes around, it'll be fine. The rates will still be low. No, they won't. We have seen the last of the super low interest rate, so make sure you take advantage of that. All right. Let's move along and talk about home equity lines of credit. Over the last decade or so, a lot of people have put home equity lines of credit on their property. Some have used them to improve the home, to do add-ons, to do all kinds of different things. Some have home equity line of credit, and they don't have a balance. They just have it there in case they need it for emergencies, and it's a great thing to have. Some have used the equity, and you might have $50,000, $100,000, $200,000 on these home equity lines of credit. I've been talking about this for the last year or so, and I'll continue talking about it. Seriously, take a look at these home equity lines of credit. When they adjust, and they will now with the prime being raised, they've already raised 1/4. It's going to affect your payment next month. If you have a home equity line of credit, you'll get your first effective payment next month. It'll go up. Even more critical when these home equity lines, when they come due, most of them have a 10-year fixed period. When they come due, they're going to go up in a big way, and they're going to recast, and especially the shock is going to be tremendous for the average person because these home equity line of credit, most of them are interest only. And it's not unlikely to see a payment, for instance, let's say you have a payment right now on $200,000 of $450 a month, $400 a month, which is super cheap because it's interest only. It's a false payment. It's based on a low prime. If that were to recast, it recasts to a principal and interest loan. And on top of that, we're assuming that with the Fed raising the prime, the rate's going to come up substantially again. You could have a payment that goes up 3-4 times that number. You could have a $400 payment now. That payment could be $1,200 or $1,300 a month, believe it or not. If it were to recast, it reamortizes to a 23-year. Remember, it goes to a principal and interest. It does not stay interest only. And the prime has gone up and will go up again. So you're really looking at something that can increase your payments quite a bit. In summary, I know this seems like a lot of detail, and for some people might say, man, oh man, I know, this is kind of boring stuff, but it's boring in a sense because it's not exciting to listen to, but it's important to listen to, and it's important to really absorb because it could save you a lot of money. So, in summary, before we close out the show today, I just want to let you know we're in a higher rate environment. If you have any adjustable rates on your first, take a look at those. If they're going to adjust in the next year or two, I would encourage you to check in, and it's a good idea possibly to fix those into a long term. If you have a home equity line and it's due to adjust, or even it's not going to adjust, I would take a look at that because as they raise the prime, remember, every time they raise the prime, that will affect your home equity line and it'll affect your payment. Now, if you have plans to pay off that home equity line or aggressively pay it down, and it's not going to really affect your cash flow or affect your liabilities, then, I would say don't worry about it. Then keep to that plan, pay it down, pay it off, and you'll be fine. If you think you're going to carry that balance for the next couple of years, I would strongly encourage that you get that either rolled into your first mortgage or fix it or do something that's going to guarantee you a payment that won't change in a big way coming soon. All right, that's all we have time-wise today. Thanks again for listening to our podcast. This is Joe Cucchiara with Real Estate Radio Live, the podcast series. Be sure if you have any questions or comments to contact us at RE Radio Live or call me at 408-838-9060. Take care.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.